Good morning, good afternoon, and good evening, friends. Let's continue with the sale of goods on approval or return basis. And we are in illustration 3. I'm in page number 5, CA Foundation, chapter 6, unit 2, page number 5. So illustration 3. Uh, Courier company sends out its gas containers to dealers on sale or return basis. Okay. So all such transactions are, however, treated as actual sales and are passed through the day books normal. And just before the end of the financial year, 100 gas containers, which cost them 900 rupees, cost is 900 rupees, each have been sent to the dealer on sale or return basis and have been debited to his account at rupees 1200 each, which is sales price is 1200, cost price is 900. Out of this, only 20 gas cylinder containers are sold at rupees 1500 each. So it means that against a normal selling price of 1200, another 300 rupees has been added to the selling price and then sold by the dealers. So we have to process this entries because for original entry, what we could have processed is like let's see what is the original entry. What is the what could have been original entry? Original entry could have been trade receivables account, uh, debit, sales account, credit. Original entry could have been for 1200 into 1200 into 100. This could have been the original entry. Right? Now what we have to process is we have to process an additional sales entry. Additional sales entry for differential price. Because it is supposed to get sold at 1200, the dealer has sold us 1500. So trade receivables account debit to sales account credit. We have to process this additional sales entry of 20 gas containers alone has been sold for 300 rupees extra. We have to process this additional entry, right? Then balance 80 is still not sold and the balance is left at stock. So we have to reverse this sales entry for the 80 cases. Reverse sales is sales account debit to trade receivables account. Sales account debit to trade receivables account. This will be for 80 containers into 1200 rupees for 96,000 rupees. Okay. Now we have to process an inventory entry also for this. Inventory on sale or return goods account, trading account credit. Sale or return goods account debit. This is for 80 cases into 900 rupees. That is for 72,000 rupees. Right? It should be taken to trading account and it will be added as part of the stock. Okay. If the goods are returned, again, I'm repeating, if the goods are returned in the subsequent period, then no entry need to be passed in the books because there is an already it has been taken into inventory. If the goods are sold the subsequent period, then you have to process a sales entry. Okay. Now let's get into illustration 4. Hope this is clear, right? This is just 4 set of entries that will get processed here. Now let's go into illustration 4. So I'm in illustration 4. Now, E Limited sends out its accounting machines costing rupees 200 each to its customer on sale or return basis. All such transactions are, however, treated like actual sales and goods under pass through the day book. Just before the end of the financial year, that is on March 24, 2016, 300 such accounting machines were sent out on an invoice price of rupees 280 each, out of which only 90 accounting machines are accepted by the customers. 200 of rupees 230 each, and as to the rest, no report is forthcoming. Show the journal entries. Okay, so before the end of the financial year, 300 accounting machines have been sent at 280 rupees, whereas it has been accepted 90 has been accepted at 230 rupees each. So it means that there is an loss or differential price which is less than the selling price. So sales, okay, let's process what is the entry. Now, first, the first entry is here's the question. Now, the first entry is trade receivables to sales account. First entry, this remains same, trade receivable to sales. We don't have to process this entry, but I'm just for the academic interest processing this entry. Trade receivables is equal to 300 machines into 280 rupees. This is the first entry. Normal sales, trade receivable to sales. Then what happens is additional sales entry for differential price. This will be in the reverse order, because it has been sold at lesser price. Yes, you're right. It has been sold at lesser price. So 90 accounting machines into 50 rupees. Right? 50 rupees is differential price between 280 to 230. So this entry has to be processed. 90 accounting machines has been processed. 250 rupees. So it is 30 rupees. Sorry. Not 50, 30 rupees. 90 accounting machine has been processed at 250 rupees, which is 30 rupees less than the output. So we are reversing the sales entry. Next, we don't have an information about the balance cases, so we have to reverse the sale. That is equal to 210 into 280 rupees. That is 58,800. 90 has been sold. Out of 390 is sold. The balance 210 is left as sale or return basis at the end of the year. Right? So we have to reverse the sale entry for this 280 cases. Then we have to take it back to inventory. Is equal to inventory. It has been inventorized at what is the cost price it is given here? $200 each. Yes. Costing rupees 200 each. So 210 machines into 200 each. That is 42,000 rupees has to be taken to inventory. Again, I'm repeating. If the goods are returned subsequently in the next year, now it is a tentative inventory entry. If it is returned the next year, we don't have to process an inventory entry because it is already there in the inventory. If it is sold, we have to process the sales entry and also account for the differential cost if it is any. Okay, now let's do illustration 5. This will, I think this contains the better example. Let's see what is there in illustration 5. Illustration 5. Now let's see what is that we have in illustration 4. 3 and 4 are easy, right? It's quite normal entries that we are crossing. Just in case you have doubt, please reach out to me. A sends out goods on approval to few customers and includes the same in the sales account. On 31/3, the trade receivables balance stood at rupees 1 lakh, which includes 7,000 goods, rupees 7,000 goods sent on approval against which no information was received during the year. These goods were sent out at 25% over and above cost price and were sent to X 4,000 and Y 3,000. Mr. X sends intimation of acceptance on 30th April and Mr. Y returned the goods on 10th April. Make the adjustment entries and show how these items will appear in the balance sheet and show how do also these entries. I think this requires some sort of understanding. We will take it as a separate class, and so that we have to process both the entries as well as inventorize them and also do the sales entries and then do the balance sheet. We'll cover it in the next class, and also we will take go through some of the test your knowledge questions, etc. in the next class. So just in case you have any doubts or clarification, please reach out to me at babupriya@rediffmail.com, or you can also post your comments onto this link video and I'll get back to you sooner. Thank you, friends, and have a great and wonderful day.